The Iran shock is not only a geopolitical event, it is a systems event. Most people will look at it as a headline. They will argue about who is right, who is wrong, what the media is exaggerating, and what the market will do tomorrow morning. That is how most people process chaos. They react to the surface. I do not think that is enough. When a shock moves through the world, the important question is not whether the headline is frightening. The important question is how the shock travels through oil, inflation, interest rates, corporate earnings, consumer behavior, capital flows, and finally the portfolios of people who were not prepared. That is the real chain. And if you do not understand the chain, you will probably become part of the crowd that reacts too late. I want you to listen carefully because what is coming is not just about Iran. It is not just about oil. It is not just about war risk. It is about how a fragile financial system responds when energy prices move sharply higher at the wrong point in the cycle. When oil prices rise, it is not an isolated price chain. Oil is not just another commodity on a screen. Oil is embedded in transportation, production, logistics, shipping, food, manufacturing, aviation, chemicals, and almost every physical layer of the economy. When oil doubles, the cost of moving things rises, the cost of producing things rises, the cost of getting goods into stores rises, and when those costs rise, they do not politely stay inside the oil market. They move outward, they become inflation pressure, they hit businesses, they hit consumers, they hit margins, they hit expectations. That is where the danger begins. Because if oil drives inflation higher at the same time the economy is weakening, the central bank is trapped. That is the scenario investors fear, but many do not understand clearly. If growth falls and inflation falls, the Federal Reserve can cut rates and support the economy. If growth falls while inflation rises, the Federal Reserve has a much harder problem. It cannot easily cut rates without risking more inflation. It cannot easily tighten without hurting growth even more. That is the environment people call stagflation, high inflation and economic weakness at the same time. It is one of the most difficult environments for policymakers because the usual tools begin to conflict with each other. If they fight inflation, they can damage jobs and credit. If they support jobs and credit, they can worsen inflation. That is why oil shocks matter. That is why geopolitical shocks matter. And that is why investors who only look at the headline usually misunderstand the real risk. But I want to be very clear about something. A shock is not only danger, a shock is also selection. It separates weak businesses from strong businesses. It separates fragile balance sheets from resilient balance sheets. It separates investors who gamble from investors who have a system. It separates people who panic from people who have prepared. That is how markets have worked for more than a century. There is always a reason to be afraid. Sometimes the reason is a war. Sometimes it is inflation. Sometimes it is a banking crisis. Sometimes it is a pandemic. Sometimes it is a technology crash. Sometimes it is a mortgage and credit collapse. Sometimes it is something nobody was discussing 3 months earlier. The name changes. The pattern repeats. That is why I do not think of crashes as something that automatically destroy wealth. Crashes destroy weak hands, weak balance sheets, weak systems, and weak thinking for prepared investors. Crashes can create some of the greatest opportunities of an entire decade. That does not mean you blindly buy everything. That is a mistake. Buying because prices are down is not a strategy. It is an impulse dressed up as courage. The right question is not, what has fallen the most? The right question is, which great businesses are being marked down by a broad crisis even though their long-term economic engines are still strengthening? That is the difference between speculation and principled investing. When everyone is calm, quality is expensive. When everyone is terrified, quality can become available. That is why disciplined investors do not live in fear of volatility. They prepare for it. The key word is survival. A great company that survives a major shock can become far more valuable after the shock than before it. The market often punishes everything together during fear. It sells the weak and the strong. It sells companies with broken futures and companies with temporary price damage. The disciplined investor's job is to distinguish between the two. Amazon is a useful example because it survived more than one major crisis. It was crushed during the dot-com collapse. It was hit again during later market stress. But the business survived, improved, and compounded because its underlying economic machine kept getting stronger. That is the type of logic I care about. Not whether a stock can go up for 3 months, not whether a commodity trade works for 6 months, not whether oil spikes because of a headline. I am thinking in years and decades. That is why I do not want to build a portfolio around chasing oil. Oil can go up sharply, it can also come down sharply. It is cyclical, it moves in ranges, it can be extreme on both sides. There may be times to trade it, but that is not the same as building a durable wealth strategy for the next 10 or 15 years. I do not want to own something only because the crisis made it temporarily popular. I want to own the kinds of companies that become more important because the world is becoming more complex, more power hungry, more automated, more data intensive, and more dependent on productivity. That is the deeper point. The Iran shock can create fear in markets. But the better long-term opportunity is not simply to buy oil. It is to use the weakness created by the shock to buy the long-term winners that the world will still need after the shock is over. The crisis is the entry point. The long-term trend is the reason that distinction matters. If you buy something only because of the crisis, you must correctly predict the crisis. You must predict timing, duration, escalation, and exit. That is very difficult. But if you buy a high-quality company that is aligned with a long-term trend and the crisis gives you a better price, you do not need to predict every move. You need to be broadly right about the long-term direction and disciplined in how you accumulate. That is how I think about this environment. The first major area is reliable power. Artificial intelligence is not a software story only. It is a power story. It is an infrastructure story. It is a cooling story. It is a grid story. It is a physical world capacity story. People talk about AI as if it lives in the cloud, but the cloud is not magic. It is data centers, chips, electricity, cooling systems, backup systems, and physical infrastructure. If AI demand grows, power demand grows. If data center complexity grows, cooling demand grows. If the grid is constrained, companies that can provide alternative or more reliable power solutions become more valuable. That is why energy exposure matters. But I do not want energy exposure that is purely tied to the commodity cycle. I do not want a portfolio that simply rises and falls with oil. That can be useful in certain windows, but it is not the core of a decade-long compounding system. I want energy exposure that connects to technology. I want businesses that serve the AI supercycle, not just the oil cycle. That is why companies connected to nuclear power, data center cooling, and on-site power production become interesting. They are not just crisis hedges, they are pieces of the infrastructure required for the next phase of computing constellation. Energy is tied to nuclear, Vertiv is tied to cooling and data center infrastructure. Bloom Energy is tied to on-site power generation that can reduce dependence on the traditional grid. Each of these has a different role, but the common thread is the same. They are connected to the physical bottlenecks behind AI. They help solve power, reliability, and infrastructure pressure. Those bottlenecks become even more important in a world where oil shocks, geopolitical instability, and grid constraints make energy reliability more valuable. That is the type of business I want to study during chaos. Not because the stock price will move in a straight line, it will not, but because the underlying need is likely to remain strong even after today. S-fear has passed. The second major area is memory. AI does not only require GPUs, it requires memory, it requires more context, it requires faster movement of data, it requires infrastructure that allows increasingly complex models and agents to function. As AI becomes more capable, the demands placed on memory rise dramatically. If we ask AI systems to do more, remember more, process more, and operate across more complex tasks, the need for high bandwidth memory becomes more important. This is one of the places where the market often underestimates bottlenecks. When there is not enough supply of something essential, the owners of the constrained capacity can benefit meaningfully, and in memory, the market is concentrated. A small number of companies control a large part of the global market. That concentration matters. Because even if others want to enter or expand, production capacity does not appear instantly. It can take years. It requires capital, equipment, expertise, supply chain, coordination, and time. That means the existing leaders can have a powerful window if demand rises faster than supply. Micron becomes important in that context because it is a US-centric way to participate in the memory bottleneck. The business is tied to high bandwidth memory, which is exactly the kind of memory AI data centers need. The stock may be volatile, it may go down after being selected. It may frustrate people who demand immediate validation, but immediate price action is not the same as long-term thesis quality. That is one of the hardest lessons for investors. A good thesis can look wrong before it looks right. A poor investor changes his mind because the price moved against him. A better investor asks whether the facts that supported the thesis have changed. If the need for memory is growing, if AI infrastructure requires more high bandwidth memory, if supply is concentrated, and if capacity cannot be built overnight, then the core logic remains worth watching. That does not mean buy blindly. It means understand what bottleneck you are trying to own. The third major area is semiconductor production. If the world is going to keep building AI infrastructure, it needs chips. It needs GPUs. It needs the machines that make chips. It needs the foundries that manufacture them. It needs design tools, it needs connectivity, it needs the entire production chain. This is where companies like NVIDIA, AMD, ASML, TSMC, Arkansas M, Cadence, and Connectivity. Related businesses become part of the broader production sleeve. Each company plays a different role. NVIDIA and AMD are tied to compute. ASML is tied to lithography equipment, which is essential for advanced semiconductors. TSMC is tied to manufacturing at enormous scale. ARM and Cadence are tied to architecture and design. Connectivity companies help data move efficiently through the system. The point is not that every one of these must be bought at any price. Price still matters. Valuation still matters. Position sizing still matters. Risk management still matters. The point is that the production chain behind AI remains one of the central economic chains of this era. In times of geopolitical stress, that chain becomes even more important. Not less. Supply chains become strategic. Domestic and allied production becomes more valuable, efficiency becomes more valuable, scarcity becomes more visible. The world remembers that advanced technology is not created by software alone. It is created by fabs, machines, chips, materials, power, cooling, and logistics. That is why chaos can increase the importance of the best production companies. It does not make them immune to drawdowns, it makes them strategically relevant. There is a big difference. The fourth major area is decision making in chaos. This is where Palantir becomes central in the original framework. In a stable world, decision making is easier. Supply chains are predictable, costs are predictable, demand is predictable, geopolitical relationships are more predictable. Data can be interpreted with less urgency in a chaotic world. The value of good decision making rises. Governments need to understand complex systems, companies need to model supply chains, defense organizations need to process intelligence, enterprises need to see risk before it hits them, institutions need tools that help them move from data to action. Palantir's role is connected to that need. It helps organizations make decisions in complex, uncertain environments. That is why it fits this type of world. It thrives not because chaos is pleasant, but because chaos increases the value of systems that help people understand and act. Cybersecurity has a similar logic. As systems become more digital, more connected, and more AI dependent, the attack surface grows. In a world of geopolitical tension, cyber risk is not theoretical. It becomes part of the operating environment. CrowdStrike fits that side of the framework because protecting systems becomes mission critical. Then there are companies tied to databases, visibility, monitoring, and cloud. Datadog, MongoDB, Oracle, Microsoft, Google, and Amazon each have different roles in how the digital enterprise operates. Some provide infrastructure, some provide data management, some provide cloud capacity, some provide monitoring and visibility. Again, the point is not to own everything. The point is to understand the categories. In a more complex world, the companies that help organizations see, decide, secure, store, compute, and operate can become more important. The fifth major area is automation and real-world productivity. When inflation rises, when labor markets are pressured, when supply chains are uncertain, and when companies need to do more with less, productivity becomes essential. Automation is not just a technology theme. It is a response to constraint. If the world becomes more expensive, companies need tools that allow them to operate more efficiently. If labor is costly or scarce, robotics and automation matter. If consumer acquisition becomes harder, better advertising platforms matter. If financial services are being rebuilt digitally, companies that improve access, efficiency, and scale matter. That is why Tesla, Meta, Amazon, SoFi, and Robinhood appear in the framework. Tesla is tied to robotics and autonomous driving. Meta is tied to advertising efficiency and large-scale digital engagement. Amazon combines cloud infrastructure with retail data and logistics. SoFi and Robinhood represent financial platform models that can benefit from digital adoption and changing consumer behavior. These are not identical businesses. They should not be analyzed as if they are. But they share a connection to productivity, automation, data, scale, and digital behavior. In a chaotic world, the best productivity companies can become more valuable because they help people and businesses operate better despite pressure. That is the core idea. Now let me step back. A list of companies is not a strategy. This is where many investors fail. They think the hard part is finding names, then they buy too much too fast at the wrong price. With no process, no cash reserve, no time horizon, no risk control, and no ability to endure volatility. Then when the market falls further, they panic. That is not investing. That is reacting. Having the right companies is not enough. You need the right system. The system begins with a core for most people. A broad S&P 500 allocation should remain an important part of the portfolio. Many people believe they can outperform the index by owning only individual stocks. Some can, most cannot. The S&P 500 provides broad exposure to U.S. corporate earnings, and it creates a foundation that reduces the pressure to be right on every individual company. That foundation matters psychologically. When you do not have a foundation, every stock becomes a referendum on your intelligence. That creates emotional decision making. The system also requires dollar cost averaging. I prefer slow, steady accumulation to impulsive buying. You do not know the bottom. No one knows the bottom. A shock can last longer than you expect. Markets can fall in waves. Good companies can decline more than seems rational. If you spend all your cash at the first discount, you may have no ability to buy when better opportunities appear later. That is why buying slowly matters. It is not because slow feels exciting. It is because slow preserves optionality. In investing, optionality is valuable. You want the ability to respond if the market gives you better prices. You want the emotional stability that comes from not needing to be perfect. You want the discipline to add when your system tells you to add, rather than when fear or excitement takes over. The system also rejects margin. No lending, no debt, no forced liquidation. A good asset bought with too much leverage can become a bad outcome. Leverage changes the nature of the game. It turns time into an enemy. It allows short-term volatility to destroy long-term logic. If you own a great business with no leverage, you can wait. If you own a great business with leverage, the market can force you out before the thesis plays out. That is why survival matters not only for companies but for investors. You must structure your portfolio so that you can survive the period when you look wrong. Because every long-term investor will look wrong at times. The question is whether you survive long enough to be right. This brings us back to history. Bull markets have historically been longer and larger than bear markets. Bear markets hurt, they create fear, they dominate headlines, they make people feel that the system is ending. But over long periods, the market has continued to rise because businesses generate revenues and profits, productivity improves, innovation continues, and human beings keep solving problems. There are always wars, there are always recessions, there are always pandemics, there are always crashes, there are always reasons to sell, but there are also always companies improving their revenues, expanding margins, building better products, and becoming more important to the economy. That is why I focus on fundamentals. The market can argue about valuation in the short term. It can obsess over insider selling, media narratives, political headlines, and fear cycles. Those things matter for price over short windows. But over the long term, the most important drivers are revenue, gross margin, operating margin, net income margin, cash flow, and the durability of the business model. If a company grows revenue and expands margins over a long period, the stock price tends to follow. Not every day, not every quarter, but over time. That is what matters. When people criticize Palantir because of valuation, competition, government exposure, or insider selling, many of them miss the more important question: what was happening to revenue? What was happening to margins? Was the business becoming more efficient? Was it becoming more essential? Was the economic engine improving? Those are the questions a serious investor asks. Noise will always be there. Noise is unlimited, but the number of variables that truly matter over long periods is smaller than people think. Revenue growth, margin expansion, competitive advantage, mission, critical relevance, balance sheet survival, long runway. Good management, a product or service the world needs more of, not less of. This is why I think of the current environment not as a reason to hide, but as a reason to prepare. If the Iran shock sends oil higher, inflation higher, and markets lower, many people will react emotionally. They will sell good assets because their screens are red. They will buy short-term crisis trades without understanding the exit. They will sit in cash and feel safe while inflation silently reduces purchasing power. They will chase whatever is already moving. That is not the way I want to operate. I want to know the businesses I would like to own before the crisis gives me the price. Preparation comes before opportunity. You cannot build a shopping list after panic has already taken over your nervous system. You build it before. Then when the market falls, you are not asking, what should I do? You are asking, has the price reached the zone where my system tells me to begin buying? That is a much better question. It is calmer, it is more rational, it is less dependent on emotion, and it is much closer to how principled investing should work. The companies in the framework are not random names. They represent needs, reliable power, cooling, on-site energy, memory compute, semiconductor production design, connectivity, decision-making, cybersecurity, databases, cloud infrastructure, automation, advertising efficiency, financial platforms, real-world productivity. If the world becomes more chaotic, these needs do not disappear. In many cases, they intensify. That is why a crisis can lower prices while raising long-term strategic importance. That combination is what creates opportunity. But I will say it again because it is important. Do not buy blindly, do not buy all at once, do not use margin, do not assume a stock is safe because the company is important, do not confuse a great theme with a great entry point. Do not let excitement replace process. A strong business can be overvalued, a good thesis can be early, a high-quality company can fall 30, 40, or 50%. A market can remain irrational longer than your emotions expect. That is why position sizing and accumulation discipline matter. The right mentality is not, I must catch the bottom. The right mentality is, I must build exposure intelligently over time to the assets I believe will matter most in the future. That is very different. When you stop trying to be perfect, you can become more disciplined. The crisis itself may be dramatic, but the response should not be dramatic. A good response is often simple. Keep a core. Maintain cash or flexibility for opportunities. Build a list of high-quality companies aligned with long-term needs. Study revenue and margins. Buy gradually, avoid debt. Do not panic sell. Do not chase short-term crisis trades. Focus on companies that can survive and thrive after the shock. That is the whole game. The world does not stop because there is a war. The world does not stop because oil rises. The world does not stop because markets fall. The world adjusts, capital flows. Businesses adapt, consumers change behavior. Governments respond, strong companies use chaos to widen the gap between themselves and weaker competitors. That is why survival in a crisis can be the beginning of dominance. Weak companies may be unable to finance themselves. They may lose customers, they may cut investment, they may dilute shareholders, they may collapse. Strong companies may continue investing, hiring, acquiring, improving, and gaining share. The market may mark them down temporarily, but the business may become more valuable structurally. That is what I look for. I want the businesses that chaos makes more necessary, not the ones that only benefit from a short-term spike. That is why oil itself is not the center of the strategy. Oil is the shock transmitter. It transmits the pressure through inflation, rates, consumer behavior, and markets. But the opportunity is found in the long-term winners that the shock temporarily discounts. That is the distinction that matters most. If you miss that distinction, you may spend the crisis chasing what already moved. If you understand it, you can use the crisis to build positions in the companies that may define the next decade energy infrastructure for AI memory bottlenecks. Semiconductor production, decision systems, cybersecurity, automation, productivity platforms, those are the areas I want to understand before the crowd is forced to understand them. Now I want to address the emotional side. Crashes feel terrible, they are supposed to. If they felt comfortable, prices would not get cheap. Opportunity rarely arrives looking calm and clean. It arrives when there are frightening headlines, falling prices, and people telling you that this time is different every time. There are reasons why this time feels different, and every time some parts are different. The specific cause changes, the emotional pattern does not. Fear makes people shorten their time horizon. They begin thinking in days when they should be thinking in years. They begin judging long-term assets by short-term price movement. They begin treating volatility as information rather than as the cost of admission. That is where mistakes happen. The disciplined investor does not deny fear. He designs a system that does not require him to act from fear. That is why I keep coming back to systems. A system tells you what matters before the market attacks your emotions. A system says, these are the businesses I want to own. These are the prices at which I begin. This is the pace at which I buy. This is the maximum risk I take. This is why I do not use debt. This is why I keep a core. This is why I measure fundamentals rather than headlines. Without a system, every headline becomes a command. With a system, every headline becomes data. There is a big difference. The Iran shock may be severe. Oil may rise, inflation may become more difficult, the Fed may be constrained, the market may fall, some investors may be wiped out because they are over-leveraged, over-concentrated, impatient, or emotionally reactive. But none of that means you must be one of them. You can prepare, you can think through the chain, you can separate short-term crisis trades from long-term compounding businesses. You can build a watch list, you can keep buying power, you can own a core index position, you can accumulate slowly, you can avoid margin, you can focus on companies whose revenues and margins are moving in the right direction, you can treat chaos as a test rather than as a command to panic. That is what good investing requires, not prediction with certainty. Preparation under uncertainty. The future is always uncertain. The mistake is believing that uncertainty means you cannot act rationally. You act by using probabilities, principles, and preparation. You accept that oil may move more or less than expected. You accept that markets may fall further than you expect. You accept that some individual stocks may underperform. You accept that you will not buy the exact bottom. You accept that the media will be noisy. You accept that fear will rise. Then you design around those realities. That is how you survive. And in investing, surviving is not a small thing. Surviving gives you the right to participate in the recovery. Surviving gives you the ability to buy when others cannot. Surviving gives you the patience to wait for fundamentals to show up in price. Surviving allows compounding to work. Many investors do not fail because they never own good companies. They fail because they could not hold them through the period when good companies look bad. They fail because they used too much leverage. They fail because they bought too fast. They fail because they had no cash when the best prices arrived. They fail because they mistook volatility for permanent impairment. They fail because they reacted to noise instead of tracking revenues and margins. That is why the process matters more than the list. But the list still matters because when the market gives you a discount, you need to know what you are trying to buy. For me, the logic of the list is clear. The next decade will require enormous power. It will require cooling. It will require on-site energy. It will require more memory. It will require chips. It will require advanced manufacturing. It will require design tools. It will require connectivity. It will require decision, making systems for complex environments. It will require cybersecurity. It will require databases and monitoring. It will require cloud infrastructure. It will require automation and productivity. A geopolitical shock may disrupt the short term, but it does not eliminate those needs. In many ways, it proves them. A world with more uncertainty needs better systems. A world with more energy pressure needs better energy infrastructure. A world with more AI demand needs more physical capacity. A world with more cyber risk needs stronger security. A world with more cost pressure needs more productivity. That is the investment frame, not fear, not hype, not prediction. A frame based on cause and effect. Oil shock creates inflation pressure. Inflation pressure constrains the Fed. Fed constraint pressures markets. Market pressure creates discounts. Discounts create opportunity and high-quality long-term winners. Long-term winners are found where the world's needs are increasing. The investor's job is to survive the volatility and accumulate intelligently. That is the chain. Once you see the chain, the situation becomes much clearer. You may still feel the uncertainty you should. It is real, but you do not have to be controlled by it. The best investors are not the ones who never feel fear. They are the ones who understand what to do while other people are ruled by fear. That is why I would not go 100% cash. Cash feels safe in a crash, but inflation can quietly destroy purchasing power over time. Over long periods, sitting entirely in cash can be one of the most expensive forms of safety. You may avoid volatility, but you also avoid growth. You may avoid a drawdown, but you may accept a slow erosion of purchasing power. That is not real safety if your time horizon is long. Real safety is not the absence of price movement. Real safety is owning assets that can preserve and increase purchasing power over time, while structuring your behavior so you are not forced to sell them at the wrong moment. That is a more mature definition of safety. It includes quality, it includes time, it includes liquidity, it includes discipline, it includes avoiding leverage, it includes not panicking. This is why inflation is more dangerous than many people realize. A crash is visible, inflation is quiet. A crash frightens you quickly, inflation cooks you slowly. A crash makes you feel poor today. Inflation makes your money worth less tomorrow, and then less again the year after that. Many investors fear the wrong enemy. They fear volatility more than loss of purchasing power. They fear temporary declines more than permanent erosion. They fear red numbers on a screen more than the long-term cost of doing nothing. That is why a crisis must be viewed correctly. You do not want to be reckless, but you also do not want to let fear push you into a strategy that cannot protect you over time. A balanced approach matters. A core index position, selective high-quality, individual companies, slow accumulation, no margin, focus on fundamentals, cash for optionality, not cash as a permanent hiding place. That is how I would think about it. Now, if the shock comes and markets sell off, many people will look for certainty. There will be none. No one will know how long it lasts. No one will know the exact bottom. No one will know the exact path of oil, interest rates, or inflation. No one will know which headline matters most tomorrow. That is why certainty is the wrong goal. The goal is not certainty. The goal is robustness. A robust system can handle being early. It can handle further declines. It can handle volatility. It can handle noise. It can handle emotional pressure because it does not rely on perfect timing. That is why dollar cost averaging is so valuable. It turns uncertainty from an enemy into a process. It allows you to participate without pretending, the bottom. It reduces the emotional burden of a single all or nothing decision. The same is true of position sizing. You should be able to be wrong for a while without being destroyed. If one position can ruin you, the position is too big. If one bad month can force you to sell, the system is too fragile. If one headline makes you abandon your plan, you did not have a plan. You had a wish. I know this sounds simple. Most important principles are simple. The difficulty is not understanding them when the market is calm. The difficulty is obeying them when the market is frightening. That is why you prepare in advance. So what should you do now? You should not wait for panic to begin thinking. You should review your portfolio. You should identify your core. You should identify which individual companies you truly understand. You should ask whether those companies are aligned with long-term needs. You should study revenue and margins. You should look at balance sheets. You should decide where you would add if prices fell. You should decide how slowly you would add. You should remove leverage if you have it. You should avoid panic buying. You should avoid panic selling. You should define your process before the market forces you to improvise. Improvisation under stress is where bad decisions are born. And if you own companies simply because they went up before, or because someone on the internet mentioned them, or because you were afraid of missing out, this is the moment to become more serious. A crisis punishes borrowed conviction. If the conviction is not yours, you will not hold when it becomes painful. You need to know why you own what you own. You need to know what would make you change your mind. You need to know whether the business is improving or deteriorating. You need to know whether the thesis is intact. That is what separates investing from following. The companies tied to AI infrastructure, memory production, decision systems, cybersecurity, cloud automation, and productivity may offer major opportunities if the market sells them down. But you must still do the work. You must still respect valuation. You must still build slowly. You must still accept volatility. There is no stock list that replaces judgment. There is no theme that removes risk. There is no crisis that guarantees wealth. But there are moments when the crowd's fear creates better odds for disciplined investors. This may be one of those moments. History is not about to be made because one headline appears. History is made when a major shock collides with a major long-term trend. Oil shock and inflation pressure are the short-term force. AI infrastructure and productivity are the long-term force. The market panic may be the bridge between them. If you understand that, You can act differently from the crowd. You will not be asking whether the world is scary. The world is often scary. You will be asking whether fear has created a better price for assets whose long-term importance has increased. That is the question. It is the same pattern that appears across history. The reason changes, the opportunity appears inside the fear. The weak sell because they cannot tolerate uncertainty. The strong buy because they prepared for it. And the companies that survive and compound become obvious only later. After the easy money has already been made. That is why preparation matters now. Not after the crash, not after the headlines peak, not after the best companies have already recovered. Now, because when chaos begins, your emotions will not give you clarity, your preparation will. I cannot tell you the exact path of oil. I cannot tell you the exact reaction of the Federal Reserve. I cannot tell you the precise bottom of the market. I cannot tell you which day will be the best day to buy. But I can tell you the principles. Oil shocks can raise inflation. Inflation can trap central banks. A trapped central bank can pressure markets. Market pressure can create discounts. Discounts matter only if you know what you want to own. The best long-term assets are usually tied to rising needs, strong fundamentals, and durable relevance. You need a system to buy them. You need the patience to hold them. You need the discipline not to destroy yourself with leverage or panic. That is enough. Investing is not about knowing everything. It is about understanding the few things that matter most and behaving consistently when everyone else is losing discipline. So if the Iran shock comes, do not let it turn you into a headline reader. Think in systems, follow the chain, watch oil, watch inflation, watch the Fed's constraint, watch market weakness, watch whether quality businesses become cheaper while their long-term importance remains intact. Then act slowly, rationally, and with discipline. That is how you defend a portfolio. That is how you use chaos. And that is how a frightening moment can become one of the most important wealth-building opportunities of the decade. For the small minority of investors who prepared before everyone else understood what was happening. The crowd will look at the crisis and see only danger. You should look at the crisis and ask which great businesses may become cheaper because other people are afraid. That is the difference. And in markets, that difference can determine whether a decade of chaos destroys your wealth or helps you build it.